What's up, beautiful people? This is Pope with Stock Doctor Trading. Thank you so much for joining us for part 2 of our 7-part series on 6 common strategies for dealing with a bouncy, bumpy bear market. So today we're going over fixed income, aka Le Boomer. And yesterday we covered the cash heavy lurker, and it's also good for us to know what are the 6 common. So let's review those really quickly. They are, number 1, cash heavy. I call this the lurker. Number 2, that's fixed income. We're calling that Le Boomer. Strategy number 3, grab your puts and your shorts and let's head to the beach. This is when you put the peaks and pops, aka the Michael Burry. Number 4, short-term hedging, aka that dirty Hedgie. Number 5, dollar cost averaging. Why don't you buy that dip, baby? Oh, let's get it. This one I'm calling the stalker, right? Because it's stalking around like. Number 6, all right, this is China stocks and emerging markets. So it's aka the trader. All right, so like I said, today we're covering Le Boomer. Now, this thing should be said first and foremost about this particular strategy. For those who are taking on this strategy, you should wear it with a badge of honor. Because if you're choosing this strategy, basically you're saying that you've gotten to the point in your life where you've earned enough wealth that the assets can actually work for you. Bravo, that is the whole point of everything. That is the golden age of your portfolio. So let's not mess it up, right? That's the point of capital appreciation, capital control, making sure you don't fall backwards. This is one of those heavily relied on strategies for a bear market for this exact reason, protecting what you've already made. And taking on the boomer strategy is not for those who are ready to take on risk to grow more wealth, but it does give you a peace of mind to know that you'll be able to be investing in a point to at least beat inflation and cover any of the losses that straight cash is going to have during the recessionary times coming up. The Le Boomer strategy is exactly where I have my parents right now. They have their own particular breakdown within this structure because we want to make sure they don't fall backwards during this bear market. All right, so if you are deciding if you're going to the direction of the Le Boomer strategy, then let's look at some of the pros and the cons. The pros, number 1, would be long-term downsides are minimized. So that's perfect for a bear market. You want to limit your downsides while protecting against inflationary pressures. That's the point of this profile, so that you can do. You can provide real returns against inflation. It's one thing to invest in a bond that's going to return you 3% when inflation's at 8%. That's a real return of negative 5%. And what we're trying to do is at least be at 0 or above that on a real return. And that's the point. Another pro is that it protects your capital while providing passive income. So this is that aspect of using your wealth to grow your wealth further, letting your money do your work for you. Fixed income investments are great for that. The Le Boomer strategy is perfect for that. But here are some cons. You can still get walloped. I mean, the short-term downsides are still increased in bear markets. If you go heavy into things like corporate bonds, municipal bonds, some of the more risky types of bonds, as we'll review some examples of different portfolio breakdowns that you might have in fixed income, you can still get whacked. And it takes a long time to come back when you go down heavy in bonds. So you want to limit your exposure to the riskier assets such as high-yielding junk bonds, which tend to be on the corporate bond level. And the last con for investing in the bonds is that if you're looking to get real returns on your inflation, you'd be investing either an I bond, which has a max level of $10,000 per year that you can invest in it, or you'll be investing in a Treasury inflation protected security, or TIPS. The thing about a TIPS is you don't want to liquidate that early. So whatever its maturity date, you really want to be keeping it in there. So that's what I mean. These kind of grab up your assets. If you're really working to beat inflation through fixed income, you're going to have to lock up some assets for a little while. And you're going to have to wait out to their maturity, or else you face higher risks in redeeming them early. That's an important thing to note about that. It's definitely one of the cons. Now, of course, we'll talk a little bit more about TIPS and bonds, but let's look at some other examples of fixed income investments and securities. So, number 1, Treasury bonds. These are guaranteed by the government. Number 2, T-bills. You can invest in something like an ETF, like TLT is the stock ticker. You have municipal bonds, corporate bonds, and of course your money markets or high yield savings. So it's a more secure aspect of that. Municipal bonds, that's when you're investing in bonds that are for infrastructure for state and local governments, and corporate bonds are issued by corporations in order to take on debt in order to make investments in the company and grow the future of the company. So, okay, so now that we have that as a rough breakdown of what a fixed income portfolio would look like, let's look at what a very risky fixed income portfolio would look like. Okay, so in that instance, what you would have is something like perhaps 45% of your portfolio invested in corporate bonds, 30% invested in municipal bonds, maybe 10% in TIPS and I bonds, 5% in Treasury bonds, 5% in TLT T-bills, and 5% in your money market and high yield to maintain a little bit of liquidity. This would be on the riskier side because you're taking on some of that corporate debt, which tends to be the riskier of all the different ratings of the bonds there. So you can see as you're breaking a portfolio percentage down, even though we're in the fixed income bracket, you can see there are different levels of risk within each one of these strategies that you can leverage and work with. And we're going to learn a lot more about leveraging and working with our percentages within a portfolio later in at the last video on day 7. So that's when we're actually going to cover what it really means to truly diversify amongst all of these strategies. All right, so now let's look at what an extremely low risk fixed income portfolio might look like. Okay, and that would be something where you're much heavier in treasury bonds, let's say 35% treasury bonds, about 20% in T-bills with TLT, you're about 15% in muni bonds, 15% in TIPS and I bonds, about 10% in money market high yield savings, and 5% in corporate bonds, staying mostly away from that. That is a less risky portfolio, but it's also quite neutered. It's going to be offered by any financial advisor that's looking to do capital appreciation, and it's not really taking into account that we're in a bear market right now. It's not taking into account that is, if you started this strategy as of today, how would it perform over the next 1 to 2 years relative to the next 5 to 10 to 15 years, which I'm sure it will do well at that span, but we want to make sure we time this right. So what I would say is you want to find somewhere in the middle that actually matches the inflation issues that we have and the bear market and recession that we have coming up. So that, I would say, would be a portfolio breakdown much more like this right here. This is heavy into your TIPS and your I bonds. That's because we're trying to get a real return on your money. We're trying to at least match inflation. And these are the investments that do that best. So it does take away the liquidity. We talked about one of the cons of this portfolio is that you're really gonna stick into it until these investments mature. But we want to be 75% heavy in TIPS and I bonds. You want to pull back, you want to have some liquidity, so you also want some growth. So you're going to have 10% in your treasury bonds are fully guaranteed. You want 10% in your money market and your high yield savings. That's money that's more liquid and available for you to make investments as you might find bottoms throughout the next year or two. And then lastly, we'll just put some money there in TLT and the T-bills, 5%. This is just to round out a diversified portfolio. Truth is, you could go as high as 80, 90, or even 100% in TIPS and I bonds during this particular time. I mean, we talked about I bonds have a maximum of 10,000 per year per Social Security number. So you're going to be limited in how many they can invest, but it's between the two, one way or the other. Really, the only difference between TIPS and I bonds is the I bonds have the max $10,000 per year that you can invest in those. TIPS require that you stay through the maturity of the entire investment, and the way they pay the interest is different. So an I bond will pay you a higher interest rate based on inflation. A TIPS will actually just increase your principal by the amount required to match inflation. So that's just kind of like a technical aspect of what makes them different. But you can lump them in the same because they're there to fight inflation. All right, beautiful people. So we just broke down all the different ways you might look at a fixed income investment. You can definitely see that there are certain types of investors that are gonna lean more heavily to the boomer strategy based on their economic circumstances. And that's the point of these different strategies, everyone finding their sweet spot and then leveraging the strategies among themselves. So thank you so much for enjoying this video with me. The next one coming up is gonna be about puts and shorts. It's called the Burry strategy, so the Michael Burry. And we're gonna have a little bit of fun with that one there. So make sure you tune in tomorrow. Do us a favor, like, comment, subscribe, help the algorithms get this video out there. It's all right. We're going to be talking about this for a long time. I'm not going anywhere. So thank you, beautiful people. Thank you for taking the time with me. Keep on block rocking, show stopping, and hope nobody's clocking. Unity. This is Pope out. Peace. If there's something strange in your portfolio, who you going to call? Stock Doctor.